welcome to the School of Stocks. I am your host, Victor Dungo. Today, we shall be talking about returns. Every business is like a machine. You put in money and you expect it to pay back. Returns measures the efficiency of paying you back. Some businesses, you can invest a $10 and then yearly you can be getting a net profit of roughly $2 or $2.50 as the case may be. Some companies, when you invest that $10, you can have just $1 in net profit, whilst other businesses with an investment of $10, you actually make a loss. So today we shall be considering three kinds of returns. One, return on assets. Two, return on equity. And three, return on invested capital. Return on asset is just a quick measure of the efficiency of that business using its asset to generate returns. You can get the total asset on the balance sheet. Remember, we spoke about the balance sheet as having what the company owns, which is called the asset, and what the company owes, which is called the liability. So if you have, say, an asset, say asset is equal to $100, and then your net income is equal to, let's say, $5. Return on asset will be equal to $5 all over $100 times 100%, which is equal to 5%. That's your return on asset. This works mostly for financial institutions. If you are trying to look, especially banks, if you are trying to look at the performance of banks, you'll be looking mostly at the return on asset, how they use customers' deposit to generate return for the shareholders. Next, return on equity. So let's assume that we go to our balance sheet. This is our balance sheet. We have our asset and liability. Let's say our asset is again $100. Remember, the asset balances liability. Let's say our normal liability is maybe $60. It means that equity be equal to $40, such that if you add both of them together, you have 100. So now, if in your income statement you have again $5, so net income equals to $5. Your return on equity would be equal to $5 divided by $40 times 100%. So that's going to give you 12.5%. The tricky thing about return on equity is that you first of all have to appreciate certain things about equity. Equity is the amount of ownership in this business. If you use equity as your yardstick and the equity is small, then rate of return on equity becomes very big. Let's assume for this same business, you are facing to borrow more and you had experienced a loss. So you borrow more and your liability becomes $80. But you had experienced a loss before, which brought your equity down to $20. Remember, we still have 100 put together. If you don't calculate return on equity for $20, you will have $5 divided by $20 times 100%, which gives you 25%. So by just a few alterations, your return on equity flings to 25%. That doesn't necessarily mean the business is better. No, it doesn't. So you have to be very careful when you are using return on equity, because equity in the business might be so slim that any little thing, the shareholders can be wiped out. In fact, the higher percentage the return on equity is, the more fearful you should be about that business. Normally, you are looking at equity in a business should be roughly greater than 40% of the liability side. So if equity is less than 40%, really you should actually watch properly before you go and buy that company. You don't want a company that has so much debt. Debt is like an elephant sitting on your head. So the higher the debt of that company, the riskier the company is for you and for your investments. The only situation whereby you can really put hand on heart and go for a company that has low return on equity is where you have a company buying back its own stocks and turning them into what you call treasury stocks. So when you buy back your stocks, you buy it at market value and you put it below this equity. When you put it below the equity, you then subtract it. Let's assume that our equity is $40. That equity, of course, has in the market is going to sell for multiple of $40. So let's assume that we bought back equity of roughly $30 market value, which reduces our number of outstanding shares. So if you then come here, you put $30 of treasury stocks, this equity automatically falls to 10. And of course, you need to know that the company actually makes money. So that 10 is not necessarily a bad thing.